Welcome back. You're still tuned into Trading Hour. It's time to put spotlight on India's Capex cycle. According to Axis Capital's latest report, with the revival in housing construction, power generation and the emergence of new sectors like green hydrogen, defense, robotics, they believe that India's Capex engine has restarted and will run for several years. To discuss more on that, we are now joined by Neelkanth Mishra, who is the Chief Economist, Axis Bank and Head of Global Research, Axis Capital. Neelkanth, good morning. Thank you so much for joining in today. It's a pleasure to be speaking with you. You know, a lot has been happening in India, and we've been talking about it being India's decade as well. When you say India's Capex engine has restarted, what is your expectation of capital formation over years? Which sectors do you think will contribute to this? And how will it contribute to the GDP growth? What are some of the estimates that you've made going ahead?
See, before we project what's going to happen in the next 5 to 7 years, it's important to think about what has happened in the past. And we dug deep into the reasons for the slowdown in capital formation, which we measure as the investment to GDP ratio or the gross fixed capital formation or GFCF GDP ratio. Of the 7% point decline in that ratio between 2012 and 22, from 34% to 27%, we found that 5% points came from the drop in investments of households in real estate. Another 3.5% came from the drop in investment in machinery by the government and the public sector. And then there were some increases like household investment in machinery or government investment in dwellings and structures. Now, the main point is that the driver of the slowdown in machinery investments was primarily investments in energy and in manufacturing, which was primarily linked to real estate. So the drop in investment was in metals, in cement, in other construction materials, in machinery. Now, as we think about the future, it's very important to see that the real estate cycle is turning. I think inventories are now reasonably low. A lot needs to be built. The market has been quite hot in the last 2-3 years, but I think the construction activity is just about starting to accelerate. The power plant addition, again, announcements have happened, but I think now the construction needs to pick up. And it is when this activity picks up that it will start showing up in GDP. If you take a step back, this is not abnormal. When you think about long-term investments or long-term deployment of savings or capital, it is mostly when people invest in houses, when governments build infrastructure, or companies invest in power plants or long duration investments that investment to GDP ratio picks up. And therefore, I think the real estate cycle is a very, very important part of the puzzle. And we think that's turning, and that's very positive for India's Capex.
Okay. Neelkanth, hi, morning. So that's one way to look at, right? The investment type, whether it's in machinery, household, what led to the decline and what will drive the recovery. Another way to look at, and that's another axis of spending, is corporate, household and government. So can you give us data on these three axes of spending, how the investment has declined in the past decade and what the recovery will look like? Because we keep talking about how government Capex has picked up.
Yeah, so government Capex has picked up. So if you see state plus central government investments, they have been quite strong in the last couple of years. Some of it, from an accounting perspective, is just the off-balance sheet spending of the central government coming onto the balance sheet. But a large part, there has been a significant improvement in our ability to spend on railways and roads and all of that. But we think in the next 4 or 5 years, this percentage, this expend as a percentage of GDP is not likely to expand. The central government has stated this explicitly. The state governments are spending a bit more than they did, but I don't think there is a lot of scope for them to expand here. The growth, in our view, will come primarily. So as we think about 31% of GDP going to 34%, in our view, nearly half and half, so about 1.6 and 1.4 will come from the increase in household spend on dwellings as people's houses get built, and the rest will come from corporate spending on machinery and somewhat on dwellings as well. The corporate spending on dwellings, on machinery, will come primarily from the power sector. So we expect that the spend on power generation capacity will rise quite meaningfully from where we are. So we've been through a 7-8 year downturn. From 2017 onwards, the spend has been quite low, but now quite a bit is needed. I think it is planned. A lot of the funding has been arranged, and now I think the investments will pick up. So in addition, we are seeing that cement companies, in anticipation of the growth in dwelling construction, have started to expand Capex. There is also some competition coming in because 2-3 large groups are competing. Most metal companies are thinking of doubling their capacities in the next 5 to 7 years. And so all of this is in anticipation. And this is very consistent with what we have seen in the past, that whenever the real estate cycle is on an upswing, the demand growth for metals and cement tends to be 4 to 5 percentage points a year higher than it is when the real estate market is in a downswing. So the growth tends to be 8-9% a year when the real estate market is doing well, and it is 4 to 5% or lower when the real estate market is not doing well. And so as this turns, it is very encouraging. And you must have seen that India's imports of steel had picked up last year as the domestic demand has been quite strong.
So a lot of ancillary industries will do well because the real estate cycle, of course, is picking up, be it cement, be it steel. Neelkanth, a lot has changed on the state level. Of course, it was a lot BJP earlier, but now we've seen the election results for Haryana, be it Jammu and Kashmir. We're talking other parties coming in and taking charge as well. Do you think that is something which could be a big risk for central government or state capex going forward? The ultimate goal would not match in a lot of cases, and that could be something that could impact the outcome?
So it is less party specific, and it is actually change happening at the state level, which I think is responding to some of the ground level changes. So let me spend a minute on this. India is going through a phase of growth where the increase in inequality is almost inevitable. That you will see that capital is in shortage and labor is in surplus. And when something like this happens, inequality goes up because the bargaining power of capital is far better than the bargaining power of labor. Now, we are the only large country which is going through this phase, as we are a fully functional democracy. And you will see political pressures, which are very natural, about addressing some of these inequalities. So what we have seen over the last 4 years, and this has happened across party lines, is that there has been a rise in income transfer schemes. So starting with Andhra Pradesh in 2020, and then Assam, and West Bengal, and then Telangana, then Madhya Pradesh, Maharashtra recently. And if you see both parties, both sides in Jammu, Kashmir and Haryana, in fact, even in Jharkhand, while JMM is offering 1,000 rupees per month to women, BJP's offer is 2,100 rupees per month. So it's across party lines, and I think it reflects the ground realities of how politics needs to be done and what the demands of the people are. The bigger question is, does this crowd out Capex? And I think it's a very important question. What we have seen in the state budget compendium this year, and remember that while Jammu, Kashmir, Haryana, to some extent Maharashtra, and also maybe Jharkhand was not part of this, but there were 9 states which had already done this. And despite that, Capex as a percentage of full year expenditure was 15.8%. So in the budgets for this year, the states in aggregate are planning to spend 15.8% of their total expenditure on Capex. This is the second highest since 2009. Some of this is also aided by the center's offer of interest-free loans for Capex. But yeah, this is an area where we need to keep a close watch. As the state's compulsion on a competitive basis, as well as perhaps the needs of the people, requires them to do more of income transfers, and their deficits are capped, so they cannot spend more than 3% of GSDP. Will they be really taking out of Capex? At least so far in the budgets this year, which includes a lot of the transfers. Remember that Telangana, MP, Andhra Pradesh, they all already have it in their budgets. despite that, the Capex numbers as a percentage of full year spend weren't really that bad.
Neelkanth, we request you to just stay on. We want to come back and talk about markets and what this revival in Capex means for individual sectors like industrial, cement, real estate, power, the ones which will drive the recovery. But by the way, for the markets, there has been a recovery. The low today was below 24,800. And now we're back in the green when it comes to the Sensex, and the Nifty is just about breaking into the green. There's been a very sharp pullback in the markets from the day's low, nearly 200 points. The Nifty is now getting closer to 25,000. The Nifty Bank too is now back in the green, up close to about 60 odd points. And spaces where you are seeing that intraday pullback, well, you've got a Bajaj Finance, you've got an IndusInd Bank, some of the Adani Group stocks, Enterprises, Ports, LTI Mindtree. These are some stocks where there has been that sharp intraday pullback. We'll continue talking about the markets and our conversation with Neelkanth. Get into a short break. We'll come back with more. Welcome back. We've been in conversation with Neelkanth Mishra, and we're talking about his report that India's Capex engine has restarted, led by real estate, house construction, power, and new investment areas. And this will run for a few more years. And therefore, the investment to GDP ratio, which fell sharply from 34% in 2012 down to 27% in 2021, will recover. So Neelkanth, the recent low in the last decade was 27%. What does that number rise to, in your opinion? And secondly, the narrative that we spoke about, the expectation, what does it mean in terms of individual sectors like power, real estate, industrials? Because many of them are trading at very high valuations. You also spoke about how cement and metals are likely to see higher growth because of the revival in the real estate cycle. So break it down for us sector by sector.
Thanks. So on the base case, if nothing else changes, so there are no other policy interventions, we expect that this ratio will jump back to 34% by 2029 or so. The upside can come from government signing free trade agreements, and we know that there are several such agreements in the offing. There are several other changes, like say, for example, on semiconductors, where I think the investment sizes can be quite major. So as perhaps a new scheme comes up, maybe we could see another round of big investments. And then in which case there could be upside to these numbers. We could also see, if we finally see some significant changes in how urban infrastructure is funded. So for example, if the Finance Commission was to allocate more funds directly to city governments, or some such changes, then we could see upside to these numbers. But on a base case, if we just allow market forces to work with no other policy interventions, we should reach about 34%. Now, the bigger question is, how do we play this in the stock markets? And from that perspective, our call is that the industrial sector, which is likely to be at the front end of the upside in order books, should be the best beneficiary, the biggest beneficiary. What we have seen as the economy has slowed down in the last 4 or 5 months, that the markets have moved towards the defensives. So we've seen the IT sector, staples, pharmaceuticals. So as the flows have kept coming into the markets and the indicators have progressively slowed, so in the last 4 or 5 months, we have seen cement volume growth slow down, power demand slow down, auto sales have been very weak. In our view, this is temporary. This is occurring because of an unintended tightening of fiscal as well as monetary conditions. We are already seeing with the RBI keeping liquidity in surplus, overnight liquidity in surplus for the last 2-3 months, that they are signaling that perhaps that on the quantity of money side, things have tightened too much and perhaps they want to ease now. We are also likely to see, as the year progresses, that government spending will pick up. In the first 5 months of the year, central government Capex was down 19% year on year, but the government is keeping its borrowing targets intact. So this is temporary. In our view, this lull or the stagnation that we've seen in some of the industrial stocks is because of some apprehensions that the economy is slowing down for good, which we don't think is going to be the case. And so that would be the biggest beneficiary. We also think that cement as a sector, which currently now has seen the volume slow down. The EBITDA per ton is at like a decade low. In our view, as the volume growth picks up, this could be, from a PE multiple perspective, also quite attractive. In our view, the financials, in fact, banks in particular, are also among the cheapest sectors. The raw material that they work with, which is money, was in short supply. M3 growth had actually temporarily dipped below 10%. It is now slightly above 10, but clearly with the liquidity conditions easing, with the Fed's easing, allowing the RBI some more room to be more relaxed with its liquidity stance, there should be more of raw material that the banks can work with, and that should be beneficial for the banks as well. For some of the other, and utilities as well, right? So that's a sector where I think if power demand, currently it is weak, and therefore I think that sector has stagnated a bit. But we expect that as the GDP grows, I think power demand will grow as well. We are less on the PE multiple side because some of the growth that you see, for example, in real estate is kind of priced in. While housing and real estate in general will do well, so a large part of that growth may be actually already priced into. And so maybe there is a period of time correction. Some of these stocks are trading at very high multiples, but the earnings growth, even for industrials, the premium to the market is at an all-time high. But the growth in EPS is 25 to 30%. So if you just hold on for that for another year, the PE multiples start to correct. We also think that some earnings upgrades are possible. So that's how broadly we would like to manifest this in the stock market.
Very comprehensive view of what different sectors and the growth there would look like. Neelkanth, we would have loved to chat a lot more, but completely out of time on this discussion today. But thank you so much for joining in today with your take on the Capex cycle and the growth drivers going forward as well. Okay, with that, we'll do one thing. We'll slip into a short break, but here's some good news for our viewers. India's business news leader is now click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store. It's right here.